For the last few decades, the global economy has operated on a single, unspoken assumption that cheap, reliable energy would flow freely across the world's oceans. On February 28, 2026, U.S.-Israeli strikes on Iran, including strikes on Iran's primary crude export hub at Karg Island, shattered that assumption. Iran effectively closed the Strait of Hormuz to commercial traffic, and shipping volume collapsed by 97%, from 138 ships per day to single digits. The IEA's Fatih Birol called it the worst energy shock the world has ever seen, worse than the 1970s oil crises and the 2022 Russia-Ukraine shock combined. In this video, we'll break down how a regional naval blockade is triggering a global economic crisis that central banks have no tools to fix. So let's start with the numbers, because the numbers are staggering. Approximately 12 million barrels per day of oil supply have been shut in, roughly 13% of global supply. For comparison, the 1973 OPEC oil embargo cut about 7% of global supply. This is roughly double that. Iranian strikes also damaged Qatar's Ras Laffan LNG complex, which handles about 20% of the world's liquefied natural gas. The market reaction was immediate. Brent crude, which was trading below $73 a barrel in late February, surged past $102 following the collapse of peace talks on April 12th. It peaked at nearly $120 in March. Physical cargoes for immediate delivery have traded at approximately $150 a barrel. European natural gas prices on the Dutch TTF benchmark more than doubled from pre-war levels of around $31 per megawatt hour to nearly $70. And these prices are now showing up in consumer data. The U.S. March CPI came in at 3.3% year over year, up from 2.4% in February. Driven almost entirely by a 21.2% surge in gasoline prices, the steepest increase since that index began in 1967. Keep that CPI breakdown in mind, because it reveals something important about what central banks can and cannot do about this. This is what economists call a supply-side inflation shock, and it creates a brutal policy trap. Here's why. Rate hikes work by suppressing demand. If people are spending too much money and bidding up prices, you raise borrowing costs and cool things down. But this inflation isn't coming from excessive spending. It's coming from a physical shortage of oil. Core CPI, which strips out energy, came in at just 2.6%. The demand side of the economy is actually well contained. The supply side is broken, and you cannot fix a broken supply chain with an interest rate. The Atlanta Fed's GDP Now model for Q1 2026 has declined to just 1.3%. So the economy is slowing at the exact moment prices are accelerating. The Fed is holding rates at 3.5% to 3.75%, essentially frozen. Markets are now pricing a 52% probability of a rate hike by year end, which would mean deliberately slowing an already slowing economy to fight a problem that interest rates cannot actually solve. The ECB faces an even worse version of this. Eurozone inflation jumped to 2.5% in March, and markets are pricing in rate hikes where, just weeks ago, they expected cuts. The OECD slashed the UK's growth forecast from 1.2% to 0.7%, the sharpest downgrade of any G20 economy, while revising UK inflation up to 4%. As far as I can tell, no major central bank has a good answer for this. But the real crisis is unfolding in the developing world. Energy is priced in US dollars. When a crisis like this hits, capital flows into the dollar as a safe haven, strengthening it against virtually every other currency. So, developing nations face a double premium. Oil prices rise, and their currencies weaken simultaneously, making each barrel even more expensive in local terms. The IMF projects emerging market inflation reaching 4.9% this year, up from a prior estimate of 3%. The World Food Program warns that 45 million additional people could face acute food insecurity due to disrupted fertilizer supplies. The Philippines has declared a national energy emergency. India, which imports 80% of its crude, is rationing natural gas. Bangladesh has implemented fuel rationing and air conditioning limits. The IMF's managing director stated bluntly that there will be no neat and clean return to the status quo ante. And that is perhaps the most important takeaway. This is not a temporary price spike. The OECD has downgraded global GDP growth to 2.9%, and even that assumes conditions don't deteriorate further. Damaged infrastructure at Saudi and Kuwaiti oil fields will take until late 2026 or into 2027 to restore. Shipping insurance premiums, rerouted supply lines, and energy risk premia are now structurally elevated. To be clear, even if the strait reopens tomorrow, the repricing of risk has already happened. The global economy was a machine optimized for efficiency. It assumed peace, open sea lanes, and $70 oil. When you remove those assumptions, the math simply stops working. Central banks cannot print oil. Governments cannot subsidize energy indefinitely without detonating their own deficits. We are moving from an era of efficiency to an era of resilience, and resilience is expensive. That cost is now permanently embedded in the price of everything. All right, guys, that wraps it up for this video. What do you think about the Strait of Hormuz crisis? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one.